Several recessions have occurred throughout the history of the United Kingdom, each with its own unique causes and resolutions. Here are some historical examples. The Great Depression, 1929 to 1930s. The Great Depression was a severe worldwide economic downturn that began in the United States with the stock market crash of 1929. The UK was heavily affected, experiencing a sharp contraction in output, widespread unemployment, and financial instability. To address the crisis, the UK government implemented expansionary fiscal policies, including increased public spending on infrastructure projects and social welfare programs. Additionally, the Bank of England pursued accommodative monetary policies, lowering interest rates and providing liquidity to support banks and financial markets. The UK's recovery was gradual, with economic growth returning in the mid-1930s, although the effects of the Depression lingered for years. The Oil Crisis Recession, 1973 to 1975. The oil crisis of 1973, triggered by geopolitical tensions in the Middle East, led to a sharp increase in oil prices and inflationary pressures worldwide. The UK economy entered a recession characterized by high inflation, rising unemployment, and sluggish growth. To address the recession, the UK government implemented various policies, including fiscal austerity measures to control inflation and reduce government borrowing. The Bank of England also tightened monetary policy to curb inflation. The recession was eventually resolved through a combination of policy adjustments, increased productivity, and improved global economic conditions. The early 1980s recession. The UK experienced a severe recession in the early 1980s, characterized by high unemployment, declining industrial output, and financial instability. The recession was driven by a combination of factors, including restrictive monetary policy, high interest rates, and global economic downturns. To address the crisis, the UK government pursued monetarist policies advocated by Prime Minister Margaret Thatcher, which focused on reducing inflation through tight control of the money supply. Additionally, the government implemented supply-side reforms aimed at deregulating markets, reducing trade union power, and promoting entrepreneurship. Although the recession was deep, the UK eventually emerged from it with lower inflation and a more flexible and competitive economy. The Global Financial Crisis, 2008-2009. The global financial crisis of 2008, triggered by the collapse of the U.S. housing market and the failure of major financial institutions, led to a severe recession in the UK and worldwide. The UK experienced a sharp contraction in output, a banking crisis, and a surge in unemployment. To address the crisis, the UK government implemented expansionary fiscal policies, including bank bailouts, stimulus packages, and temporary tax cuts. The Bank of England also pursued aggressive monetary easing, lowering interest rates to historic lows and implementing quantitative easing programs. The recession gradually abated, and the UK economy returned to growth, although the recovery was slow and uneven. These historical examples demonstrate that recessions in the UK have been resolved through a combination of fiscal, monetary, and structural policies, as well as external factors such as changes in global economic conditions. Each recession has presented unique challenges and required tailored policy responses to stabilize the economy, restore confidence, and promote long-term growth and prosperity.